Seriously, did this come down to analysts getting the number of outstanding shares wrong?
I know that Stephanie gets upset when there's math on your show.
You know, me and Career Barbie, math is hard. What the heck happened here?
So math is hard, and apparently it was hard for the company. Look, so here's what happened. The company came out with their earnings yesterday. They lost a ton of money. On an earnings per share basis, what they lost on a GAAP basis, $2.64. Now, this is their first quarter as a public company, and when they went public, there were a bunch of funky things that happened to the share count. There were warrants that were exercised. There were convertible preferred shares that were converted back into common shares. And that caused the share count to do a funny jiggle in its first quarter as a public company. Apparently, some of the analysts had it wrong. I called Box to try to figure out who those analysts were, and they wouldn't out them for me this morning. We're going to have Aaron Levy on our show at Bloomberg West this afternoon, so maybe we'll get it out of him. But the bottom line was the share count of a handful of analysts was dramatically different than the rest of the analysts. So the average of the estimates was actually not at all like what it might have been, say, the median of the estimates. They missed the average of the estimates. They beat the median of the estimates. And so for those who only compare earnings per share and compare it to estimates, it looked like a miss.
So, Corey, I know that you have built and run dozens, if not hundreds, of models in your time, not just as an expert television presenter, but previously as a hedge fund analyst. And how often does this happen? How can this is a public company? This is a public company that had a fairly high-profile IPO.
So a couple things. So first of all, building a model is kind of a pain, and it's a pain in the butt when you get to things like earnings per share of a company that just went public because of these very issues. But you know, and indeed, I have a model on Box, and my earnings per shares are a mess because you never really know quite how the conversion is supposed to work, or they're around certain numbers, and you can't get it to square with theirs. And when a company reports a quarter, it's maddening to rapidly try to fill in your model and get the things to update just the way the company has done it, and then see if the company is actually trying to pull a fast one over on you, because it happens. But this is what the CFO should have done before the earnings call, is call the analyst and say, hey, we looked at your note, where'd you get that number?
Right. Okay, then,
and
Corey,
that's what usually happens.
Could this be a sign, maybe this is a stretch, that we are in a tech bubble universe where a relatively immature company run by people who don't have a ton of experience in this space, boom, have a hot IPO, first quarter we see as a public company, this kind of oversight? I'm not sure if we would see this from a mature company. It seems pretty silly to me.
I would agree with you, and I like the CEO quite a bit. The CFO is also they have this wonderful story. Their first funding came from winning money in online poker. That's where the CFO sort of started his money. He raised $20,000 from winning online poker, and that's how they bootstrapped this company. They got their first venture capital interest at a beer-soaked party in Atherton, where someone introduced them to a venture capitalist, and that led to some funding.
That is totally rad. Someone should write a book about it. But should they buy the stock of a company where they have this kind of mistake the first quarter?
This is the most heavily shorted tech stock.
These are risk factors, right? I'm just looking it up. I don't know the company that well, but Dylan Smith, the CFO and co-founder, is 29 years old. Doesn't have any previous experience at a public company.
Right. And this is where their investor relations team should be helping out, and this is where their bankers should be helping out. And frankly, if some analyst has got numbers that are very different, that analyst might want to run that by the company as well. But I think, you know, Box has issues besides this issue of earnings per share. It is the most heavily shorted tech stock on the New York Stock Exchange. That's it, Box. 39% of the float is sold short. So as far down as the stock is today, it would be even worse if there weren't short sellers covering. And the problem with this business is that they're spending 88% of sales is going into marketing, and that's the best it's ever been in the quarter that they just reported. So they've got to prove that the money that they spend in marketing, they're not just paying people to be customers, and that the money they spend on marketing leads to a long-term customer, not just someone that they're kind of running on a treadmill. This quarter didn't quite do that.